Good evening, ladies and gentlemen, and welcome along to this IC Markets webinar using Fibonacci tools in your daily trading. My name's Chloe, I'm with Trade with Precision, and I'll be with you for the next hour talking all things Fibonacci. Before we get started, just a little bit by way of an introduction of myself. I'm a trader based in London. I've been trading for just over 10 years now. I trade all markets from Forex to commodities, indices, and other leverage markets as well. I'm predominantly a technical trader and a momentum or trend-based trader. So I'd say 95% of my trading is with the trend, with the overall momentum of the market. So welcome along, everyone. I would just like to give you this opportunity to have a look at this next slide, which is the risk disclaimer slide. Make sure you agree with everything therein, and then we can get started. I'd also like to check that you can hear me okay. So if you wouldn't mind popping into the questions box that you can hear me okay, that you can see my screen okay, that would be fantastic. Let's just have a look. Fantastic, thanks Phil, thanks for the feedback. Awesome stuff. All right, and by way of an apology in advance, I do have a little toddler whose bedtime it is, so if any of that noise carries through, then my apologies. There's probably going to be some screeching, some giggling, some complaining, I imagine. Apologies if any of that carries through to you guys. So that should be enough time to have read through that slide. I'd like to keep this session as interactive as possible. So if you do have any questions as we go through, then please do feel free to fire those away into the questions box. I'll do my best to get through as many questions as I can in the time that I have. If there are any particular markets that you want me to have a look at, for example, then perhaps we'll get to that at the end as well. So let's have a look then at the agenda for today. Today we're going to be looking at setting up and understanding the Fibonacci tools. We're going to talk about using Fibonacci to identify entry and exit points, and we're going to be doing that as a live demo on the IC Markets platform. And in answer to your question, yes, I am a professional trader. That is my profession. All of us who do webinars at Trade with Precision are professional traders. Okay, so without further ado, I'm going to take you straight to the platform. Bear with me while I get that screen up for you. Okay, so you should now see my IC Markets MT5 platform, which is what I am going to be using for this webinar. And I think to get started, let's open a new chart and let's just get a blank screen. So I'm just going to right click over here in the Market Watch and open a new chart window, and then I'm going to load a template. I'm just going to load a blank template there. And I'm just going to click onto the daily time frame. So this is euro dollar on the daily time frame, just to start off with as an example. So I just want a completely clean chart, just so that we can really purely have a look at the Fibonacci. And then what I'm going to do is I'm going to put some other things on the chart as well, because that might help us as we go through putting together the Fibonacci with other things that I use for my trading. Because Fibonacci is a very, very powerful tool, but it's not a tool that I use as a standalone indicator. I use it in combination with other things, so I will show you those other things as well. So first of all, the first thing on the agenda was talking about setting up the Fibonacci tool. So for those of you who are not familiar with the Fibonacci tool on MT5, it's just up here in the toolbars. All of these toolbars we can hover over, and if we hover the mouse over it, it will pop up with what the actual tool or the button does. So I'm going to come up here. This is the Fibonacci tool here. It actually tells you that this is the Fibonacci retracement tool. Now, I actually do use it for retracements and extensions, and I'll show you how I've set that up. So first of all, I'm going to click onto that, and then the most important thing about Fibonacci is how we draw it. So in a downtrend, to measure a retracement, we want to use the tool by drawing from the most recent high to the lowest point, the most recent low. So let's just say that we were looking at the chart over here, for example. Let's say we were looking at this part of the chart. So I'm going to use that to draw a Fibonacci from the most recent high, which is just here, all the way to the lowest point that I see on my chart. So that is my Fibonacci tool. In a downtrend, it's from the most recent high to the most recent lowest point. Now, what I'm now going to do is I'm actually going to right click. You can see here I've got these spots on the Fibonacci, one in the middle and one on either end, which means it's selected. I'm then going to right click and I'm going to this settings thing, the properties of daily Fibo. And if I click on that, then it brings up this box with the parameters. So we can do things like changing the colors and stuff like that. That's standard for most indicators available for MT4, MT5. The thing that I'm interested in is the next tab along, which is the levels tab. So Fibonacci retracement. Fibonacci is a series of numbers, and the Fibonacci numbers are ubiquitous throughout nature, throughout a lot of things in the world, you know, things from snail shells to flower, like sunflower heads, and there are all kinds of things that in the world that occur in nature according to Fibonacci ratios. So it's a series of numbers that is very, very well known, I suppose. And the Fibonacci retracement numbers that are most commonly used, we can see here. So we've got the 23.6% retracement, the 38.2% retracement. The 50% retracement level is on the Fibonacci tool, usually by default, or you can add it on. Now 50% is not a Fibonacci retracement number. 50% is simply the halfway mark. It's the halfway retracement of any move. And it's just very, very commonly looked at, and an easy way to measure it is by adding it onto the Fibonacci tool. So the 50% retracement is not a Fibonacci number, but a lot of people do use the Fibonacci tool to put that 50% retracement level on, just so that they can see where it is, because it's a very commonly looked at level. Then we've got the 61.8 level, which is also very important. Above that, it's the 78.6 level. So those are the main Fibonacci retracement levels. Now, while we're talking about setting up the tool, and you can add any levels that you want just by clicking over here, clicking on add, and you can type the number in down here and the label for it there. But I want to show you a couple of levels that I have added on here, which actually put extension values onto my Fibonacci tool as well. So the commonly used Fibonacci extension values are 161.8 and 261.8. And in order to get those on your Fibonacci retracement tool, which I find useful just so I can have it all in one, you know, I just place the Fibonacci retracement tool on my chart, and I've got my retracement values and my extension values all in that one tool. So that's why I've got them here. So in order to get the 161.8 extension, that would actually be the minus 0.618 retracement, if you like. So if you type in minus 0.618 here under add, so we can just type that in here, minus 0.618, and then you can label that. You can write your own label here. So I would label that 161.8. Obviously I'm duplicating this, but just to give you an example, that will give the 161.8 extension. And then if you type in as well minus 1.618, that will give you the 261.8 extension value. So those are the two most commonly used extension, or the two that I use most commonly, certainly. So if you want those onto your Fibonacci retracement tool, then by all means add them. I'm just going to delete that one off. It's a duplication. So you will see, I'm just going to click OK there. You will see on this Fibonacci retracement tool that it has drawn the 23.6 retracement, 38.2, 50, 61.8, 78.6, and obviously 100 is just the top of the move there. And in addition to that, it has also drawn the 161.8 extension and the 261.8 extension. So this webinar, I think, we're probably mainly going to be covering Fibonacci retracements, but if you do want to use extensions, then there are ways of getting that on your tool. Okay, so in terms of using the Fibonacci retracement tool, the most in a strongly trending market, the retracement levels that are most of value are the area between the 38.2 retracement and the 61.8 retracement. So 38.2, 50 and 61.8 would be the areas that I would be looking for price to retrace to in a smoothly trending market. If price retraces further than 61.8, and if it comes, for example, up to 78.6, then I would see that as a very deep retracement, which may potentially have a greater probability of then moving forward. It doesn't necessarily mean a reversal straight away, but it may then move forward to give us a higher low and then potentially a change in trend or a range. So if this move here were to have retraced up to the 78.6 retracement, I would be looking more, I would be looking at a higher probability chance that yes, price could move down again and continue with the trend for a while, but it's more likely to then form a higher low and then perhaps start ranging or even changing direction, because that's a very, very deep retracement. It means that there are a lot more buyers coming back into the market and the sellers aren't quite able to keep that market smoothly trending downwards. So really, the levels that I would be looking at for a strongly trending market would be around this area between the 38.2 retracement level and the 61.8 retracement level. Now, how do we know which level any market is going to retrace to? Well, of course, we cannot possibly know with 100% certainty. And this is where I find it very useful to use other factors as well, other indicators as well in my trading, in order to be sure that I'm looking at an area of high probability to be going back in the direction of the trend. So what we're looking for with Fibonacci retracements is we're looking at, of course, we're looking at trend, and the idea is with trend trading is we want to be trading in the direction of the trend. Trend is a series of lower highs and lower lows, or higher highs and higher lows. And it's our job as trend traders, and I'm going to talk about a downtrend because you know, we've got a downtrend on the chart. It's our job as trend traders to get in at the highest price we can see in order to take advantage of the next move to the downside in the direction of the trend. So we're always on the hunt for a pullback followed by a return to trend, a pullback followed by a return to trend, a pullback followed by a return to trend, pullback followed by a return to trend, because we want to take advantage of those pullbacks to give us a slightly higher price so that when we do get into the market, it's more likely that price will move down for a longer period of time and give us our profit. As opposed to getting in, just anywhere in a downtrend, because we might perhaps get in down here and then the market could move against us and take our trade into negative territory, or even stop us out of the trade, depending on where the stop loss would be. So while it is important, obviously, to identify trend and direction, it's even more important to get the timing right. And one of the things that we can do to identify these peaks and troughs in the market is use Fibonacci. So if I, for example, put a Fibonacci tool on here, I'll go from the highest point to the lowest point. Let me just take this one off, actually. Highest point to the lowest point of that particular swing. And we can see here that price pulled back, first of all, to the 38.2. Eventually, it pulled back to the 50% level before returning to trend. If I then take that off and look at the next swing, so highest point down to the lowest point there, then again, prices pull back to around the 50% level there before moving back downwards. And we can look at, for example, this high point down to here, and again, very much liking this 50% retracement level the euro is at the moment. This high down to this one, and again, it's the 50% level that is favored. Now, how do we know that price is going to turn around at that 50% level? Well, we don't know, but what we can do is we can build some other indicators into our trading. So I'm going to put some moving averages onto my chart. The moving averages I'm going to put onto my chart are the 10 moving average. I use the exponential moving average. I'm going to put that on in black there. I'm going to put another moving average, which is going to be the 20 moving average in blue. I'm going to put another moving average. In fact, I suppose we don't even really need any more moving averages than that. I'm just going to use the 10 and the 20 moving averages. The other thing that I want to cover slightly, and I'm not going to be able to cover it in much depth in the time that we have, but I want to point out that horizontal levels of support and resistance are very, very important in my trading as well. And it's another factor that I use. So what I'm now going to start to do is build a picture of several layers that I use in my trading in order to give me an accurate and highly probable entry. Not with 100% certainty, because that would be impossible, but adding each of these layers in gives me a higher probability of success. So horizontal levels of support and resistance. And in order to draw horizontal levels of support and resistance, I will go all the way back to the monthly time frame using this tool here, drawing the horizontal line, and I will pick out any important levels that I can see of potential support and resistance. So one here is around 1.05, another one up here at around 1.145. I will then go down to the weekly time frame to see if I can fine tune those levels slightly. And I will go to the daily time frame as well. to look at those levels. Depending on the time frame I'm trading, I may even go down further than that. If I'm looking at support and resistance, then I will look at previous highs and previous lows as well. So, for example, over here, this area here, where I've got these two lows, once I've got two touches at a level, then that becomes a potential level of support or resistance. So that's a level that I would draw in. Much the same as over here, I would see some support over here in this area that I would draw in, and perhaps we might be able to get a little bit more. Probably not really over here, I wouldn't say. Let's get rid of that one. So horizontal levels, and it's a little bit more tricky at the moment on euro-dollar because price has actually gone lower than we've seen. So drawing horizontal levels based on past price action is actually not possible. The other thing that I can do is use large round numbers. So for example, parity. So let's put parity. So we'll just edit the properties of this and put value at 1. So that would be parity. So that level there of €1 to $1 is a very, very important psychological level. Now, how is this all related to Fibonacci, you might ask, and it's a perfectly valid question. My point being that I don't use Fibonacci as a standalone tool. I use it in combination with other things. Horizontal levels are one of the things that I do use a lot in my trading. So if I'm looking at, let's just go from up here. So if I'm looking from up here, I've got my downtrend and I want to see where price is likely to retrace to. So I'm going to draw my Fibonacci retracement again from the top here down to the bottom of this move. Where is price likely to retrace? Well, I would be looking for an area where I've got a confluence of things. For example, a confluence between a Fibonacci level and a horizontal level. And I would be looking in this area between the 38.2 and the 61.8, and I would be looking for something else to show me evidence in that area that a change in direction could take place. That could be a moving average. So I'm going to again I'll put another moving average on here, which is the 50 in red. And we'll see there that the 50 moving average is there. And that coincides pretty nicely with the 38.2 Fibonacci level. And it's not a million miles away from this horizontal level here either. Let's move on to the next swing. So from this high down to this low, and again, is there a Fibonacci level that coincides with perhaps a horizontal level? Well, over here we certainly have that, so the 50% Fibonacci level and this horizontal level here. We also have the 38.2% retracement level, which corresponds quite nicely with that 20 moving average. So it's all about tying things in together and working out if there is an area of confluence between the Fibonacci levels and anything else on your chart. Now, I don't really have time in this hour to teach a full strategy. So perhaps those of you who are already trading have strategies that you're already using. And one of the things that could be possible is, excuse me, you could start to use Fibonacci and look at it and see if it might help in your trading, see if it might help as an additional factor that you're looking for in order to find a really fine-tuned entry. The other thing that we can do is, of course, this is talking about the daily time frame, but those of you who are actually intraday traders, what we can do is we can look at this on an intraday basis. We can also look at Fibonacci on a daily time frame and go down to a lower time frame to try and fine-tune the entry further. So, for example, here, where we have seen a pullback, let me see if I can. No, we'll use this example. Examples are never perfect, but let's say here we've got this move to the downside, and we've got a pullback that came to the 38.2 level here, and it coincided with around this area of the 20 moving average just here. Now, what would happen if we used that? I'll just place a marker there, and we went down to a lower time frame, perhaps the hourly time frame. So if we can find where we need to be. So we've got this full move to the downside, and then we've got a pullback that comes to the 38.2 retracement level. Is there any way we could get into that on a lower time frame and trade it on a lower time frame, which would give us perhaps a more accurate entry, a smaller distance between entry and stop loss, and therefore perhaps a higher reward to risk trade? This particular example that I've picked out isn't fantastic because there's some very choppy price action, but even so, it could be possible to yeah, this isn't the best example, but it could be possible to look at that 38.2 level, look at price action on the hourly time frame, and what I would be looking for is I would be looking for a trend change on the hourly time frame, because a 38% retracement on a daily time frame is more often than not going to look like an uptrend on an hourly time frame. And so to indicate that that retracement is over and the downtrend is going to resume, what we could do is we could actually look for an indication that that hourly trend is over and a downtrend is about to resume. Now, this example gives us very, very choppy price action here, but you can see how that might be a possibility. And I think I'll just go up to, I'll go back to here and try another one. So we've got this one here. We've got price here retracing to the 38.2 as well. So let's look from here onwards on the hourly time frame. So again here, there's the full move. Here is the uptrend on the hourly time frame. It's come to the 38.2% retracement on the daily time frame. So then I would be going down to a lower time frame to look for evidence that price could be reversing around this area. And actually here we do have evidence because we've got a lower high at that point and a lower low. Now again, quite spiky price action here, but certainly one option could be to wait for price to come back below this 38.2% retracement level, wait for lower highs and lower lows, place an entry once we have strong bearish price action, for example, over here where we see this very strong bearish candle, and place a stop loss above the highs up here. And that would that would give us an entry based on the fact that we believe the 38.2% is the retracement level, and we're trying to get as fine-tuned as an entry as we possibly can on this hourly time frame while still remaining safe. So we still want the stop loss to be up above that high, because what we're looking for is we're looking to trade trend and cyclicity. So on an hourly time frame, if we've got an uptrend on the hourly time frame, which is the retracement on the daily time frame, in order to see that that uptrend is over and a downtrend has started, we need to see lower highs and lower lows. And if we're going to trade those lower highs and lower lows based on the thinking that that is the turning point of the market, then surely we want our stop loss to be above the highs, because that's where we would be proved wrong if the market was going to continue upwards rather than turning round at that retracement level. So the stop loss wants to be above the highs there, and we could place our entry where we get this very bearish candle here. We could even place an entry below the low of the candle, stop loss above the high point there, and potentially that could enter us into the trade. Now, what then happens is price doesn't actually continue downwards for very far, and eventually it comes up to the 50% level. But again, we can do the same thing. We can say, okay, so the 38.2% level failed. Let's try and see where is it next likely to go to. It's next likely to go to the 50% level. Again, we've got higher highs and higher lows all the way up here, and then we suddenly at this 50% level get a lower high, lower low. In fact, this looks a little bit like, those of you who trade chart patterns or are aware of chart patterns, a little bit like a head and shoulders pattern there, reversal pattern. So again, we get this very bearish candle here, which forms a lower high. We then get a break of the low, so we could have a stop loss up at the top there with an entry down here. And as long as the stop loss is above the Fibonacci level and above the highs of that time frame, then that could be a suitable place to have an entry and a stop loss. And that's one way of using this on a lower time frame. Of course, it is also possible to simply use Fibonacci on this time frame that we're trading. So if you're an hourly time frame trader, then absolutely you can also just use the trend on the hourly time frame. For example, let's have a look. Let me delete this one. And let's have a look at the Fibonacci on the hourly time frame. So we could go from, let's say, this high here down to the low, and we could see around a 23.6% retracement, or we could use this one here down to the low there. That's around a 38.2% retracement. But all the while, I wouldn't just be looking for the Fibonacci retracement numbers. I would be looking for some kind of confluence. So here, for example, the 38.2 also coincides with this 10 moving average. So price has pulled back into this area of the moving averages, and this area in and around the 10 and 20 moving averages I call the equilibrium zone. And it's where price often pulls back to in a strong trend and then moves away from. So that's a suitable area to look for those Fibonacci levels in conjunction with the moving average area in order to look for a return to the downside. And then you can quite simply just look at the bar by bar price action around here. So how do we know that price is going to turn around at the 38.2% retracement level? Well, we don't know that. How do we know it's going to turn around at the 10 moving average? We don't know that. By overlaying the 38.2 Fibonacci level with the 10 moving average, that gives us a higher degree of probability. But how do we know for certain? Well, again, we can't know for certain, but this retracement consists of mainly buyer bars. In fact, this particular retracement does consist of all buyer bars, but most retracements consist mainly of buyer bars in a downtrend. And once you start seeing more seller bars, that's when potentially the move to the downside could be about to begin. So once we've got an area that we're looking out for, 38.2 for example, and the 10 moving average, then we've got green bar, green bar, green bar, red bar. Now price could continue upwards, of course it could, but if this is an indication that the buyers are exhausted from this pullback and the sellers are going to come back into the market and return things to the downtrend, then price will carry on downwards. And so if we place an entry below that seller candle with a stop loss above, then if price continues downwards, then we'll be entered into the trade and we can trade it down. If price continues upwards, i.e. the 38.2 wasn't the right level and price is still going to move further upwards, then we simply won't be entered into the trade. So again, it's not necessarily using the Fibonacci and choosing 38.2 and pressing buy or sell at that level. It's a combination of various different factors that we can overlay onto the chart to give us a higher probability of success. Now, why did I put those Fibonacci extension numbers onto my chart? Well, those are commonly used levels for targeting trades. So the Fibonacci extension, let me just get rid of that and go back to the daily time frame. Fibonacci extension, for example, let's go from this high down to this low. And there's the 50% retracement, and then also we've got the extension levels 161.8 and 261.8. Those are very commonly used targets. So potentially if you were to be trading this pullback, you may simply have a target of 161.8. It is frequent that if price retraces to around the 61.8 level, then the likely target could be 161.8, which is why I often use that, because I'm often looking for retracements that are kind of between the 50% level and the 61.8% level around here, and therefore I would be looking to target around the 161.8 level. So that's why I've got you there. Okay, so Phil is asking, would I place a pending order or watch market for confirmation? Phil, I'm going to go back to that hourly time frame because I assume that that's the time frame that you were probably talking about. Let's see if I can, I'm not sure if I can find that same example, but let's have a look. Over here it was. So would I use a pending order or would I watch the market for confirmation? I would use a pending order. The reason I would use a pending order is predominantly to remove emotion from my trading. When I first started trading, I had no idea that it was going to be the emotional side of things and the psychological side of things that I would struggle most with. I had no idea that that would be such a huge factor. My background before I became a trader is actually as a scientist, and so I don't have a problem really learning things. I don't have a problem with technical analysis of anything. I don't have a problem in that respect at all. And so I kind of was a little bit what word do I want to say? A little bit over ambitious, I suppose, when I first started to trade, because I didn't realize that I was going to struggle as much as I did. And the reason I struggled was because of the emotion, because I went from being a scientist where there is a right or wrong. There's always a right answer and a wrong answer in science. Whereas with trading, there's never really a right answer or a wrong answer, because you can make the right decision and the market could still go against you, because the market will do what it's going to do. The market doesn't care whether you decided the market was going to go down or up on that particular day at that particular time. So you can do absolutely everything right to the best of your ability, and you can still end up losing money. And that doesn't mean that you did something wrong. It just meant that that particular trade was going to lose money. And I found that very, very emotional. And coupled with that, the fact of the matter is that when we enter a trade, once we've got a trade live in the market, we immediately see a profit or a loss in our account. We can see the numbers ticking along, and they're either black or they're red. We're either making a profit or we're making a loss. And that can be emotional. First of all, if we've got a connection to that money, you know, a lot of people do trade with money they can't afford to lose, even though they shouldn't. And therefore, if they do start to lose that money, then that can be a very, very emotional thing. But also there's a lot of emotion connected with the desire to be right and the desire not to be wrong. And so I found it very, very all too easy to enter a trade and then become emotional about it and either exit the trade early or exit the trade for a loss when it should have been left open to take profit, or you know, taking profits early because I was too scared to see it turn around and go against me, and all of these kinds of bad decisions that we can make when we're live in the market. And so I very quickly realized that it was my emotions that were going to be the downfall of me as a trader. And I needed a way to really keep control of that. And my way is to always enter the market and exit the market based on orders. And I would say still to this day, the majority of my trading, probably 90% of my trading, is purely based on orders. So I will find an area that I want to get into the market, and I will find an excuse to get into that market, and I will find a price that makes me wrong. So my entry is when I'm proved right. If we use this as an example, so I think that price has retraced far enough here. I think price is going to turn around. It was my 38.2% retracement level previously when I had that drawn on here. I've got this seller candle here. So I think that price has retraced to here and it's going to go down. So my entry is where I'm proved right. If the market does go down, I get entered into the market, I'm right, and it goes down. My stop loss is where I'm proved wrong. This wasn't the high, and price is going to continue going higher, therefore I don't want to be in this until I can see another suitable entry. So my entry is where I'm proved right, my stop loss is where I'm proved wrong, and I'll place a target as well. Now targeting is a little bit more involved, and people have so many different methods of doing that. It can either be as a proportion of your risk, so maybe I might want to just place a 2-to-1 and take profit once price has moved twice the distance of my stop loss away, or maybe I might want to pick a horizontal level. For example, there's obviously a horizontal level here, so I could pick that. I could pick more than one target, etc. Plenty of things that can be done there, but mainly my entry and my stop loss are based on are orders, and they're based on where am I right and where am I wrong. And same for the target. I will pick a target before I enter the trade, and I'll place my entry, my stop loss, my target, and then I can close my computer down and walk away. And I don't have to have any emotions in that at all. So apologies, that was a very long-winded answer to your question about would I place a pending order or watch the market for confirmation. It's always, for me, a pending order. Even if I'm trading on a lower time frame, even if I'm trading on the 15-minute time frame, for example, it will still always be based on a pending order on that 15-minute time frame. So let's have a look at some other markets where we may find Fibonacci useful. Another thing I should say actually is that Fibonacci can be a very, very useful tool in trending markets. It is not such a useful tool if the market is not trending. So it's very important to be able to recognize trend first before you start putting Fibonacci on your charts. Because if you try and use Fibonacci on a chart that's not trending, I'll just try and find an example of a chart that's not trending. So, for example, over here, try and use Fibonacci over here in this area. It's just not going to tell us anything. You know, we can draw it from the high of that to the low, and you know, it's not going to tell us anything. We can draw from the low to the high, and equally it's just not going to tell us anything. So it's very important to first of all identify a trending market and then decide to use your Fibonacci tool. Let's look at dollar yen and just see how it could work on here. So we've got just so that you can see an example of an uptrend as well as a downtrend. So you've got from the low here to the highest point, prices pulled back to around the 23.6 level on that occasion. Over here, we've got from this low to this high here, and we can see that that price has pulled back to the 38.2% Fibonacci level, and it coincides with the area of the 10 and 20 moving averages there. We can go from this most recent low to this most recent high. And again, we've got price ranging in between this area, between the 23.6 retracement level. Now, 23.6 retracement level is a level that price can often retrace to, and it sometimes will not get further than the 23.6 if it's a very strongly trending market. So this dollar yen market has been very strongly trending and remains very strongly trending. Really, it's just having a little bit of a think about things right now, but it's very common that in a strongly trending market, price could only retrace to the 23.6, and so in that case, I would simply be looking for other things to indicate that that's as far as price is going to retrace, and it could continue further from there. So in this case, again, it's come into this area of the 10 moving average here. So looking at current markets, and now, as I said, it can only be used in trend really. So all I can do with dollar yen right now, so I've got my most recent low, but I haven't actually got a high point yet. So this actually, in terms of complete moves, this is my most recent low, that is my most recent high, and what I'm working out now is where is this retracement going to come to? At the moment, it's come to around this 50% level. That coincides with the 10 and 20 moving averages down here. It also coincides, price is also retraced to this previous high, which was resistance. We saw a lot of resistance over here, resistance, a lot of resistance here, and price has pulled back to that area. So there's another area of confluence there. So this is the area that I'm focusing on. That's where I believe that this pullback has potentially ended, and price may be going to continue upwards from here. Now, what I would do in this instance is I would actually be now going down to a lower time frame. Let's take it down to the hourly time frame just to see what's going on the hourly time frame. and I would be looking to see evidence on the hourly time frame that a pullback is over. So here's the pullback. That's potentially over. We're starting to see price bottoming out here. Certainly buyers coming into the market very strongly at this point, and over here as well. And so what I'm going to start to look for now is I'm going to start to look for price to turn around. I'm going to start to look for a higher high, which I have already seen up here. Then I'm going to be looking for a higher low, and then that's the area that I'll start to look for buying opportunities, and perhaps place my entry above the 38.2 Fibonacci level and a stop loss beneath the low, which is well beneath that 38.2 Fibonacci level there. Any more questions or any more markets that you guys want me to look at? I'm more than happy to cover more markets if you would like to see more markets. I think that was pretty much all that I wanted to really talk about with Fibonacci for today. That's all the technicals anyway. So indices. Let's have a look then at any indices in particular. I'm going to look at, let's look at the US 500. So with Fibonacci, I mean, we can look at this very, very long extended uptrend on the US 500, and Fibonacci was particularly useful in that period of time because the markets were trending so very strongly. Looking at the markets right now, I would say probably the most useful place to use Fibonacci would be actually on the weekly time frame here, because we've got this high point up here, low point down here. Price has pulled back to the 50% retracement level, so I still see it as possible that price could continue the downtrend. If price had pulled back further, again, as I mentioned, up to the 78.6, then I would be potentially considering that as the beginnings of or the warnings of a reversal. But at the moment, price has pulled back to the 50% retracement level. I'm just also going to look at, because we can sometimes overlay Fibonacci, I'm going to look from this high to this low and see where they come out. So that retracement there from this high to this low is the 61.8 level. That coincides with the 50% level of the previous move. So we can sometimes overlay them. So neither of those retracements has come as far as the 78.6. So I still see that as entirely possible that we could be continuing to look for downtrend. So over here, here's that weekly move to the downside. This is the pullback. It's come up to the 50% level. On the daily time frame, I would now be looking for lower highs and lower lows to indicate the return to the downside. Again, here on the daily time frame, I actually have higher highs and higher lows, and it just is starting to look like perhaps a lower high and lower low might start to form, in which case I would then be looking for short entries, and it's likely that I would go down to a lower time frame in order to do that. So just to finish off then, let me go back to just give you some contact details. So IC Markets has a fantastic customer support team. So if you would like to get in touch with them, then you can email them support@icmarkets.com there. They've got a phone number that you can reach if you prefer to speak to someone over the phone. And they've got all the usual socials as well, so Twitter, Instagram and Facebook. In answer to your question, Phil, I personally, yes, do only trade trending markets. As I said, I would say above 95% of my trading is on trending markets. The reason for that is because I feel that it's where the easiest profits are to be made. In a trending market, the market is more likely to move further in the direction of the trend than against the trend. And I like to pick out high reward to risk opportunities. And so I'm more likely to be able to enter a trade and for it to run to a high reward opportunity if I'm trading with the direction of the overall market flow. So yes, I do pretty much exclusively trade trending markets, and it's not actually difficult to find a trending market. You know, in previous years, it has been the indices. I mean, a trend trader could have just made a living from trading the US indices, the Nasdaq and the S&P and the Dow Jones over the last few years. Also, commodities can trend really nicely, and perhaps not made so much money if they're trying to trade trends on currencies. But now, over this particular year, the currencies have been trending beautifully. So as long as you know how to recognize a trend, then I would say trend trading for me is the easiest way to make money from trading. In answer to the question, what is a reasonable percentage profit to make on a monthly basis on your account? That would very much depend, Phil, on what time frame you are trading, how much time you are dedicating to trading. Are you trading full time? Are you trading part time? There are so many factors there that could have an impact on what a reasonable percentage return on a monthly basis would be. It would also potentially depend on, are you trading your own money? Are you trading investors' money? These kind of, you know, if you're trading a fund with money from investors, then generally investors are much more concerned about what is the downside rather than what is the upside, which is the right way to be. You know, you've got to control your risk. So investors would be more interested in a small drawdown of perhaps 2 or 3% drawdown and a modest upside of maybe 5%, rather than a huge 30% a month profit but with a 15% drawdown. So it really does depend, Phil. If you're asking for me personally, then personally, percentage profit on a monthly basis, I would say between 3 and 10% myself. And it can vary wildly because, of course, markets don't trend all the time. So I make profit when the market's trending, and I sit on my hands when it's not trending, and don't make so much profit in those times. And I'm okay with that. Okay, so thank you very much for being with me for this hour. I hope you found some benefit, and I do hope to speak to you in another webinar in the not too distant future. If there are, of course, any other topics that you want us to cover, then do drop an email to support@icmarkets.com with your suggestions. If there's any particular burning questions you have or topics that you want us to cover, we'd be more than happy to do that for you. So until next time, have a fantastic evening. Cheers, everyone.